What's up YouTube, Carboss here, back in another video where we talk cards, money investing. And today I'm going to talk about a question I've been getting pretty often lately since I started doing trading cards full-time, right? And that's the difference between trading card and real estate, right? So why are we talking about real estate? So of course, from an investment perspective, real estate or investment properties is kind of like the traditional investment vehicle that most people are quite familiar with. In fact, I bet some of you do have your own investment properties. So in this video, I'm not going to talk about what's better in terms of cars or real estate, but we're just going to talk about the different characteristics and why they are similar and dissimilar at the same time. Check it out. Alright, welcome back. So let's talk a bit about real estate or investment property. So most of you are quite familiar with it. It's a condo or a house or a property that's basically used for capital appreciation or for rent, right? Pretty simple. So most of the times investment properties can range between $20,000-$50,000 for a small unit up to hundreds of thousands or $1 million. So lots of capital investment, and most of the time you would have to require to take some sort of financing or a loan or a mortgage, right, in order to finance the purchase of property, and maybe spend a bit of cost to fix it up, do it up, renovate, fittings, fit outs, and then rent out for a certain period of time, or to flip or to sell. So there are a couple of avenues in terms of real estate or investment properties, which I'm pretty sure that most of you guys are familiar with. Okay, but the key points that we talk about investment properties is basically, number one, they are tangible assets, means they are something physical, right? So they're not the kind of paper investments like a bond or a shares or equity. So there is something physical which you can see, which you can feel, which you can touch, obviously. Number two, there are of course heavy investments. There is usually huge capital outlay. You're talking about a couple of $1,000s, or in fact maybe more, 10 or 20,000, depending on the size of the unit, as well as some upfront costs in terms of fit outs, like what I mentioned earlier, or renovation and whatnot. And going forward, there is of course the upkeep cost of those investment properties, maybe the taxes and repair and maintenance and things like that, right? So those are the things that what expenses, outflows. Of course, there's inflows as well. If you have an investment property, you will likely to rent out, and get rental income on a monthly or annual basis, or short-term rentals for Airbnb, for example. That's one avenue. And at some point in time, you probably will sell the property, and those property will likely appreciate in value, which you have a huge capital gain. Alright, so let's talk about trading cards right now here. So obviously, it's something that's quite tangible, right? So you can feel, you can touch. And there is of course initial outlay for trading cards, right? So you could spend, like in this case, this Michael Jordan here, you could spend like a couple $100, or of course you can go for some big one like this BGS 9 rookie card, right? So this is in of course the $9,000 to $10,000 range. So there is a lot of range similar to real estate, right? So you got the low end ones and you also got the high end ones. So of course, trading cards, you can keep them, you can store them, you can enjoy them, you can collect them, but they do not generate income. And that, what I meant by income, they don't actually give any interest, give any dividends, give any yield. So as long as you hold the cards in your hand or in your binder, in your box, it does not do anything for you, okay? But of course, when you talk about capital appreciation, it can go both ways, right? So it's unlike real estate, most of the times properties actually increase in value, whereas trading cards, they can actually go up or down depending on the cards that you actually own. Now, most of the times you acquire cards with cash, okay, or trade. But let's say we use an example of cash. It's a very rare situations that you take up financing. I seriously don't recommend that you take some sort of borrowing unless you actually absolutely know what you're doing. So the level of risk, it depends on how many cards you can accumulate. It just depends on how much money you have in your bank. So kind of like, it's pretty simple, right? So you can, based on what I just explained on real estate and trading cards, you can actually look at what are the similarities between the two and roughly what differences. So I'm just going to talk a bit about details right after this. Okay, so let's now get into the meat of this video. We talk a bit about characteristics of real estate, and we talk a bit about trading cards as well. So that's going to combine these two together and put them side by side and then discuss on what I think is great and what I think is not between the two. Okay, so first and foremost, obviously before investing in either real estate or trading cards, you need to have some level of research, obviously, right? So when we talk about real estate, you got to look at location, what kind of property, what kind of potential returns that you can get from that particular unit in that area. Okay, capital appreciation, and of course take into consideration things of what kind of facilities, amenities, rental potential, and all those kind of things, right? When you look at trading cards, it's pretty similar as well, right? If you talk about sports cards, you look at a particular player, what team is in, what kind of cards, whether it's an auto or rookie. So a lot of factors that goes into research as well. So it's not quite straightforward, just pinpoint one similar to properties. So after you've done the research, obviously there's a part on the initial outlay. I mentioned earlier, for real estate, the initial outlay is generally a bit higher. So you got to do things like $10,000 or $50,000 depending on the kind of property that you want to go in, which involves down payment for the property as well as other costs as well, the fit outs, renovation costs, and things like that. So there is a huge initial outlay for real estate. Now for cars, right? So of course there is a requirement of initial outlay, but the initial outlay varies depending on your budget. You could start something like $500, as low as that, or you could go up to $10,000, $15,000, depending on your budget. So obviously, both requires initial outlay, but there is a bit more flexibility in terms of what you can do with cars depending on how much money you have. Now, subsequent to the initial outlay, you talk about financing. I mentioned a bit about mortgage and loans earlier. So typically with any investment property, let's say for example, you want to buy a $200,000 property, you pay an upfront cost of let's say $40,000. Okay, you still have to come back with $160K so mortgage. So there's the monthly mortgage payments that you need to service. Obviously, there will be rental income, which we'll talk a bit about later, but this is cash outflows in addition to the initial outlay that you put in. Now, whereas for talking about cards, right? So there is not much there is no financing. Okay, so when you buy a card for $1,000, it's cash, $1,000, that's it. Now, of course, if you want to buy more cards, you need more cash. Generally, you could of course take financing, put it on a credit card and things like that. I don't normally advise that, unless you really know what you're doing. But beyond spending what you have today, there is very little financing that actually happens in terms of for trading cards. Okay, so once you get all those in, and obviously during the period of holding, the investment property, or in this case the trading cards, for cards there is no cash flows, right? When you hold a card, when you buy it to hold, let's say for 5 years or 10 years, there is no actually income. Okay, there's no cash flows. Whereas for investment properties, there is of course rental income, which you can offset the financing cost, to allow the rent to kind of like pay for the property, in that example. So, but based on cash flows, right, during the period when you're holding each of these investments, side by side, you don't have any yields from trading cards. So of course, when you come to the point of divestment, when you want to sell, okay, so obviously for properties, there is a general rule of thumb of appreciation between 3 to 7% per annum. So at that point in time, it will be about 10 years. For example, when you want to sell, you can make a huge chunk of profit. Now for cars, obviously there's capital appreciation as well, but not necessarily in that kind of straight line. We've gone through the pandemic where cars went up by 3x, 5x, 10x, right? And has come back down, in similar amazing fashion as well. So cars have that kind of volatility when you want to divest, but of course, it's part and parcel of the game, right? Similar to equities, bonds, and stocks. Okay, so you have that kind of risk factor, which is not the same as investment properties. Now, of course, doesn't mean that properties doesn't have downside. We have experienced through the property bubble burst before, but those situations are pretty rare. Okay. So obviously when it comes to divestment, there is also a process that has to go in. So we talk about real estate, you have to get an agent, you got to do a showing, and go through the process of paperwork. So depending on which country you are, the process is a bit different. So for my case, in Malaysia, it takes about between 3 to 6 months in general to dispose of the property, okay, to go through the papers, the lawyers, the showings, a bunch of things happens, right? So 3 to 6 months to move one property. Whereas for cards, right? So cards are pretty easy. Head on the marketplace, post on Facebook, depending on what you want, how much money you want to make or how much money you want to lose. Okay, that's the price you're going to get. Typically, it can happen within hours if you're fast enough, depending on the card that you actually invest in. Okay, so one thing I didn't touch on earlier is about how many spins of the dice that you have. So whereas we talk about investment property, unless of course you have a lot of money, typically you would invest in one, maybe two, okay, depending on how well you do. But when you go in, you generally buy one. Whereas when you talk about trading cards, if you have a budget of, let's say, $10,000, you could buy 10 $1,000 cards or 100 $100 cards. So it works in many ways, right? So typically for cards, you have that a bit more flexibility compared to real estate. Okay, so this might come shocking to you. I personally do not invest in real estate, and I would say 90% of my investments into trading cards. Now you might think that that's a shocker, right? So much risk into pieces of cardboard, okay? And why not, do some divestment? I'm a believer of all in, okay? It's not that I don't like real estate. I don't like several characteristics of real estate, which is what I explained to you earlier. It takes too long to move, and you can't really spread your risk. Trading cards, you can buy a portfolio of players. Yeah, you can have a portfolio of properties, as you go along, right? If you are like a property millionaire, you've read the news, you have like 10 houses, 10 units, 20, you get to the stage, great, okay? But to start out, I can't be like, okay, I'm gonna buy one house, I'm making 2 and 3 and 4 within the next 10 years. I want to go in cards, I want to go in wide, cast my net really wide and try to do as much as I can. Of course, both comes with familiarity, both comes with experience, and both comes with a lot of research and a lot of luck as well. So generally, you want to do what's best for you, what works for you, and trading cards definitely is the one that works for me. But the main factor for me is definitely still liquidity, the ability for you, for example, put in 50K today, okay, and ability for you to get 55 tomorrow or maybe 45, but the fact that you get cash come back in pretty quickly versus property, the turnaround time is just too much for me. So that's the main, I would say, driving factor for me in terms of for cards, whereas the liquidity is just it's just so advantageous, right? In order for you to get cash quickly, to reinvest, to redeploy, to reposition, or even in fact for emergency funds as well. Alright, so I've only been talking about the good things about cards in general. So what is the bad thing? Okay, so the number one bad thing about cards is the underlying asset of this card is this piece of cardboard. Okay, so when things go sideways, okay, you can't really do anything with this, right? You can't play with it, you can't eat it, you can toss it around. Maybe TCG, there's a bit of utility, you can still play over the kitchen table with your family and friends, but end of the day, it's just a piece of cardboard that you just look at. There is no monetary value when things go sideways. Okay, it's just a collectible. Whereas talk about investment properties or real estate, right? It's still a brick and mortar house. You can live in it. You could still rent it. It still does stuff for you because end of the day, it's still a house. You still need shelter, or people still need shelter. So it still carries some value. So that's the risk of collectibles. Okay, that's the risk for cards. Okay, that you operate in. So, but that's why it's very important for when you do your research, you got to consider not just the card itself, but in the environment that we're operating in. There's a lot of talks about the economic downturn, the market crash, and things like that. So you got to be mindful of what's going on, and because end of the day, trading cards is funded via disposable income by most people. So in the absence of disposable income, there is very little liquidity or new cash flowing to the market, which will affect the liquidity and which will affect investors, flippers, or people like myself, moving cards full time. So whereas real estate, I'm not saying that it doesn't have the downturns as well. It's just much rarer. So for cards and collectibles, you are definitely more susceptible to the ups and downs of the economic swings. So before I end the video, I will just pose a question to you guys, which is a question I posed to me. So if you had like $50,000, would you put a down payment into a real estate investment property, or would you buy a stack of cards? So this is a pretty interesting question that, comment down below and tell me what you guys think. So I have some different answers from my friends. So obviously people who are not familiar with cards, they just say, I'm going to put investment property because that's the simple thing that they bought a house before, not necessarily investment property. So for me personally, like I said, I enjoy liquidity. I put in 50K today. It's possible that maybe tomorrow I may get 55 or maybe 45, right? But I know that I should be able to get back my money pretty quickly if I actually need the money. Whereas investment property, there is time, there is a lot of hoops to jump through, and lots of stuff to consider as well. So that's my own personal take. Let me know what you guys think. So thanks for watching, guys. Do like and subscribe, follow this channel. Until the next one, Campos out.